What happens to the cash value of my policy when I die? And why those who say whole life insurance is a bad investment don't know what they're talking about. I made a video about this previously titled, Does Beneficiary Get Death Benefit Plus Cash Value? So if you saw that video, this will mostly be the same information. But someone who was determined to make something or someone a liar and a scam posted the question on my channel, what happens to the cash value of my policy when I die? Well, after I posted the answer explaining how the cash value gets incorporated in the death benefit, said poster was still determined, regardless of reason, to make me out a liar and accused me as such. Doing a little research, I found another person's video insisting that whole life insurance is a terrible investment. They also claimed that investing in mutual funds, whether through retirement accounts or otherwise, you would realize returns of 7% per year. No mention of risk or loss, or even the up and down nature of stocks and funds. Sounds a lot like Ramsey and Orman to me. But let me address the cash value and death benefit question first. It's different with different insurance providers. Most providers are stock companies, so they do not offer participating policies, but mutual companies do. And this is a very important distinction. A policy that is not participating has a set guaranteed interest rate that is paid to the cash value of the policy, usually between 2.5% and 4% per year. It will never be more than what the particular provider guarantees. And the face value or death benefit will never grow. We use only mutual companies and the top mutual companies that for our infinite banking tax-free cash growth warehouse policies because they offer dividends on top of the guaranteed interest and therefore they are participating policies. That is, the policies participate in the profits of the company by means of the dividends. 2 thumbs up, baby. So typically, these participating policies also allow for the death benefit to grow with paid up additions that the dividends paid to the policy buy. In either case, both with stock and mutual companies, the cash value is not an entirely separate thing. That is, the cash value that builds in the policy is available to access via policy loans or even surrender, but the total death benefit is not. On the other hand, the cash value is incorporated as part of the death benefit. So with the non-participating policies, the cash value grows as the premiums pay for more of the death benefit and the interest is added to it. And that amount of cash value becomes available to access. But when the insured person dies, the beneficiary does not get the death benefit and the cash value as separate added benefit. No. But in the case of mutual company, that is increasing the death benefit by paid up additions paid for with the participating dividends. The total death benefit does include the value of the death of the cash value that has grown within the policy. In the case of the stock company, the cash value simply reflects the total amount of death benefit that has been fully paid for up to the current time. The death benefit does not grow, but the owner of the policy has access to the cash value that has accrued. With the participating policies from mutual companies and the death benefit growing with paid up additions paid for by the dividends, the cash value becomes included in the death benefit as that benefit grows. Let me give you an example. A policy designed for infinite banking for a 35-year-old male, non-tobacco user, standard health rating with a death benefit of $500,000. The total premium is $836 per month. By the end of the first year, the cash value is $6,639. And the death benefit has grown to $525,840. So you see that the death benefit has grown by $25,840 with the paid up additions bought by the dividends and premium contributions of the riders that are part of this design. By year 10, the cash value has grown to $96,337. And the death benefit has grown to $740,432. So if the insured were to die at that point, his beneficiary would not receive the $740,000 of death benefit plus the $96,000 of cash value. No, but the $740,000 death benefit includes more than the original $500,000 plus the $96,000 of cash value. Get it? Okay. By year 25, this policy will have a death benefit of $1,057,262. And the cash value will have grown to $362,957, which is more than $200,000 greater than the original $500,000 death benefit, plus the accumulated cash value of $363,000. By the maturation date of this policy, which is at age 100 of the insured, the cash value will be $2,107,409, and the death benefit will be $2,107,409. And at that point, if the insured is still living, he will receive the total death benefit as a cash surrender of the policy. At full maturity of the policy, the owner will have paid into it a total of $524,593. You see, the premium decreases throughout the life of these special infinite banking designs. So that means he will receive 4 times what he paid in, or over 400% gain, and that will be delivered tax-free. Now remember, all that growth within the policy is tax-free. Accessing it by means of policy loans with no penalties, as there would be with any other kind of account, either by way of tax penalties for early withdrawals or simply by the fact that withdrawals from any other account stops the compounding interest growth. And those policy loans can provide a tax deduction for the owners, for the owner of the policy, as that money is put to use in other areas. And the growth is not subject to losses due to the fluctuations in the market, as investments in the market are. In addition, growth is guaranteed, unlike what the market offers. So those who claim that a 7% annual gain compounding over the years in stocks and funds are a sure thing are simply misleading all those who take their word for it. Look up the public records of average returns from indexed funds, and you will see that the actual gains are more like 4% on average. And then you'll have to pay taxes on those gains when you take the withdrawals. So after taxes, you might end up with something like 3% annual gain average, no free access, and no tax deductions along the way. Now, don't get me wrong. I do not advocate that whole life insurance should be your only savings or investment vehicle. No, I do advocate that it should be your first financial vehicle, because I believe that one should exercise caution and safety in everything. And it makes good sense to build a safe, secure, and guaranteed financial base before putting your money at risk, doesn't it? I mean, in my way of thinking, only money that you can afford to lose should be invested in anything that presents the possibility of loss. For more on the comparisons between retirement account investments and properly designed infinite banking accounts, check out my videos Dave Ramsey and Susie Orman are wrong. Qualified plans versus participating whole life, and infinite banking versus 401k for retirement. I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. So if you found this to be helpful, please hit the thumbs up, like this video, and subscribe to this channel. Also, please post your questions and comments here. For a complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.